Let's be honest, the recent market crash has been brutal. After the tariff hikes and trade disputes sent shockwaves through the global economy, many of us watched our portfolio values plummet. It's a painful reminder of what we saw in 2020 and back in 2008. History tells us with absolute certainty that it will happen again. The worst part? Most investors know they should have some protection in place, but they either do nothing, paralyzed by how complex it all seems, or they panic sell at the exact wrong time, locking in their losses. They see their life savings evaporate because they didn't have a battle plan. It doesn't have to be that way. It's not about trying to predict the next crash. It's about preparing for it. In this video, I'm going to walk you through a simple 3-step playbook the pros use to build a resilient, crash-proof portfolio. We're going to demystify some of the tools that might seem intimidating, like ETFs, options, and futures, and show you how to use them as your financial armor. By the end of this, you'll have a clear, actionable plan to protect your wealth and sleep soundly, no matter what the market throws at you. Step 1. Build an all-weather foundation with ETFs. Alright, step 1 is the bedrock of this entire strategy. It isn't some complex trading system. It's about building the right foundation from the ground up. For decades, investors were told a simple 60-40 mix of stocks and bonds was all you needed. But as we've seen recently during a real crisis, assets that are supposed to move in opposite directions can all nosedive together. This is where the all-weather concept, made famous by investor Ray Dalio, comes into play. The goal is to build a portfolio that can perform reasonably well no matter what the economy is doing, whether we're in a recession, a high-growth boom, or battling inflation. The key is true diversification across assets that react differently under different kinds of pressure. So, how do you build this? With a strategic mix of exchange-traded funds or ETFs. Think of these as the concrete and steel of your financial fortress. First, you need broad exposure to stocks for that long-term growth. An ETF like the Vanguard Total Stock Market ETF, VTI, gives you a small piece of thousands of US stocks, so you're capturing the power of the whole economy. Second, long-term government bonds. When fear is running high and the economy slows, investors flock to the safety of US Treasuries. An ETF like the iShares 20-plus year Treasury Bond ETF, TLT, provides this stability. During a stock market panic, these bonds often go up in value, acting as a crucial counterbalance to your stocks. Third, you need a way to fight inflation, the silent killer of wealth. When the value of a dollar is dropping, you want assets that hold their value. Gold is the classic answer here. An ETF like SPDR Gold Shares, GLD, gives you direct exposure to the price of gold, which often does well when uncertainty and inflation are on the rise. And finally, consider adding what's called a low volatility ETF. A fund like the Invesco S&P 500 Low Volatility ETF, SPLV, holds stocks that historically have had smoother rides, fewer dramatic price swings. Think of it as a seatbelt for your stocks. It won't prevent an accident, but it can dampen the impact. By combining these 4 types of ETFs, broad market stocks, long-term bonds, gold, and low volatility stocks, you've built a core portfolio that isn't just making one single bet on the future. You have different parts designed to work in different economic seasons. This is the first and most essential layer of your defense. Step 2. Buy insurance for your portfolio with options. Once your foundation is solid, it's time for step 2. Buying an insurance policy for your investments. This is where options come in. I know that word can make some people nervous, but let's think about it in a really simple way. You have car insurance, right? You pay a small premium every month, hoping you never need it. But if you do get into an accident, that policy saves you from a financial catastrophe. Protective options work the same way for your portfolio. This isn't about wild speculation, it's about smart protection. The most straightforward way to do this is by buying protective puts. A put option gives you the right, but not the obligation, to sell an asset at a set price, the strike price, before a certain date. Let's make that real. Imagine your portfolio roughly follows the S&P 500, which we can track with the SPY ETF. Let's say SPY is trading at $500. You're worried about a drop in the next few months. You could buy a SPY put option with a strike price of $480 that expires in 3 months. What happens next? If the market stays flat or goes up, your option just expires worthless. You lose the small premium you paid for it. That was your insurance cost. But if the market tanks and SPY falls to $400, your put option, which gives you the right to sell at $480, becomes incredibly valuable. The profit you make from that option can offset a huge chunk of the losses in your main portfolio. You've essentially put a floor under your losses. The main drawback is the cost. Like any insurance, it comes with a premium, and that premium gets more expensive when everyone is scared. This brings us to a slightly more advanced strategy called a protective collar. This is how you can get that same protection for a much lower cost, sometimes for practically nothing. Here's how it works. You still buy that protective put to guard your downside, but at the same time you sell a call option at a higher price. Selling that call gives someone else the right to buy your shares from you, but only if they hit that higher price. For example, with SPY at $500, you'd buy the $480 put for protection, and at the same time, sell a $520 call. The cash you get from selling the call helps pay for or completely covers the cost of the put. So what's the catch? By selling that call, you're capping your potential upside at $520. If the market rips higher, your shares might get called away from you at that price. For many investors, that's a trade-off worth making. You give up some of the explosive upside in exchange for low-cost protection on the downside. Section 3. Step 3. Use professional tools for active hedging. So far, you've built your all-weather foundation, and you know how to use options as an insurance policy. Now it's time for Step 3, where we'll look at the tools active investors and pros use for more direct and powerful hedging: futures and inverse ETFs. First, let's talk about selling index futures. It sounds complicated, but the idea is simple. When you own stocks, you're long the market. You make money when it goes up. Selling a futures contract is the exact opposite. It's a short position that makes money when the market goes down. By selling futures contracts that match your portfolio's value, you can create an almost perfect hedge. For example, if you have a $200,000 portfolio of large-cap stocks, you could sell an equivalent amount of E-mini S&P 500 futures. If the market then drops 10%, your stock portfolio loses about $20,000. But your short futures position would gain about $20,000, effectively neutralizing your loss. The power of futures is in their efficiency. You can hedge a large portfolio with a relatively small amount of capital. But I have to be clear, this is a tool for experienced investors. It requires a special trading account, a deep understanding of margin, and you have to actively manage it. For those who want a similar result without opening a futures account, there's a much more accessible tool: inverse ETFs. These are funds designed to do the opposite of the index they track. For instance, the ProShares Short S&P 500 ETF, ticker SH, is built to go up by 1% on any day the S&P 500 goes down by 1%. If you're worried about a short-term drop, you can buy an inverse ETF as a temporary hedge right in your regular brokerage account. Now, I have to give you a critical warning about these products. Inverse ETFs are designed for short-term use only, and by that I mean for a single day. Because of how they're rebalanced daily, holding them for weeks or months can cause major problems, and you could lose money, even if the market moves in the direction you wanted. Think of them as a tactical tool for a few days, not a permanent fixture in your portfolio. And that's the playbook, a clear 3-step plan to build a truly resilient portfolio. First, you build an unshakable foundation with that diversified, all-weather mix of ETFs, so you're ready for any economic season. Second, you treat protection like insurance, using simple option strategies like protective puts and collars to put a floor under your losses. And third, for those who want to be more hands-on, you have professional-grade tools like index futures and inverse ETFs for powerful, active hedging. The goal here isn't to live in fear of the next crash. Crashes are a natural, inevitable part of the market cycle. The goal is to have a plan. By taking these steps, you're moving from a position of fear to one of strength and preparation. You are taking back control of your financial future. If you found this video valuable, do me a favor and hit that subscribe button and ring the bell so you don't miss what's coming next. And I have a question for you. Based on what you learned today, what is the one action you plan to take this week to make your portfolio more resilient? Let me know in the comments below. I will read every single one. Thanks for watching, and I'll see you in the next video.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.